So lots going on right now. We want to talk about a market update and then an outlook, what we think might happen. Truth be told, we don't know what's going to happen, particularly in this crazy world. But we got some ideas and things that will affect what's going on in financial markets and otherwise as well. I'm reading a book on Douglas MacArthur and his biography. He's a fascinating guy for those of you who haven't read about him. And as I was putting this together, his big phrase when he came back to the Philippines was, "I have returned." So I thought about the bear market and is it saying I have returned? We'll talk about that. So where do we go from here? A couple things. Probably the most important, the thing I want to spend the most time on is what to watch. We don't want to confer you a degree in finance because then we wouldn't have a job. But there's so much information out there from friends, from colleagues, from the internet, from web, from just outright lies too, that we want you to know kind of what to pay attention to. So that's what we'll touch on and spend a good bit of time on. Then we'll also talk about equities and stocks, what's going on there and what we think might happen. And then really interestingly to us is fixed income and bonds. What's going on with those and interest rates. So what to watch? What do we want you to pay attention to? Well, the Ukraine instability. The markets, financial markets, hate any kind of uncertainty. And of course, when there's an invasion or talk of an invasion, that creates uncertainty. And if Ukraine does get invaded, which it looks like it will, that's going to wreak havoc on the financial markets for uncertainty, but also for natural resources. Because Russia exports a lot of oil and exports a lot of natural gas to countries that support Ukraine. So the geopolitical part of this, in addition to the uncertainty, is something you want to pay attention to. We can't stop it, and we certainly can't time it, but it's going to affect the financial markets if that happens. The other thing you want to pay attention to is happening right now. Quarterly earnings coming out from the fourth quarter. So in the fourth quarter of 2021, October, November, and December, those companies are reporting earnings right now in the month of January and then into February. And on the whole, they've been pretty good, which is kind of surprising. But because 2021 was a really good year and the fourth quarter continues to look like it was a really good quarter. And so when companies report earnings and they're positive or they beat expectations, stocks usually do well. And that's probably why we saw a dip and we've seen some return over the last few days to some normalcy or some recovery in the equity markets. So pay attention to quarterly earnings coming out. And then inflation. Anybody heard anything about inflation lately? And specifically labor costs. Inflation is a big topic. We certainly have inflation going to the grocery store, going to the gas pump. But remember, we had no inflation for 10 years, up until about 6 to 9 months ago. That doesn't mean we're not going to have inflation, but sometimes it's comparative. And labor costs, that's really what's driving a lot of this. The unemployment rate is hovering around 4%, which is really full unemployment if you think about it. If we've got unemployment at 4%, the people who are in that 4% probably don't want a job because there's so many jobs out there. So that's causing pressure, labor costs, and that's a lot of what's causing costs to go up. What's interesting, I looked at a statistic, I love this statistic. In 1997, 27% of the workforce was 55 and above. Today, 37% of the workforce is 55 and above. So guess what that means? This is going to get worse. This is not going to get better. And so what's happened, as you probably know, with 401k and the stock market just rocketing over the last 4 or 5 years, these folks that are close to retirement and having to deal with the pandemic have said, I'm done with it. So they've gotten out of the workforce, and that again has made the labor shortage really, really bad and probably not going to get better. So that's a lot of what's driving this. And then of course, we talked about this before in some of our briefings, demographics. I'm at the tail end of the baby boomers, and we're going to retire. And we're going to put strains on the economy. And so that's something that you need to pay attention to, inflation, but most specifically, labor costs. Interest rates. You hear about the Fed talking about interest rates. They're going to raise rates. Need to pay attention to interest rates. All of you are clients, and you've heard when we get together, we talk about interest rates and how it affects our decisions, both on the bond and fixed income side, but on the stock side as well, as you'll see. So pay attention to interest rates, and we'll talk a little bit more about those as well. The dollar strengthening as Feds raise interest rates. So as the Feds raise interest rates, that's going to strengthen the dollar in relation to other currencies. What does that mean to us here in the United States? Well, it means companies that are exporting to countries outside of the United States are going to have a hard time, because when the dollar strengthens, those goods just got more expensive. Okay, so that's going to be a headwind. It's going to strengthen. Also, if you have international investments as a U.S. citizen, those are going to have a headwind because they're denominated in a currency other than the U.S. dollar that just lost value. So I got kind of technical there, but pay attention to the strengthening dollar. It sounds good if you're going out of the country, but it can be a headwind in other ways as well. The pandemic and infection rates, perception over reality. This is not a political statement, but we see when something happens, when 1 million people die, which is a tragedy, but it gets all the press and it gets people stirred up and it creates uncertainty. But what are we in the end of the pandemic with Omicron? I'd like to think so, but who knows? But certainly that's going to affect uncertainty in the markets and what's happening to our world. And has it affected us? You think about it, over the last 2 years, we've been in a pandemic and we've had incredible performance in the financial markets. So who knows what's going to happen? And then lastly, I threw this one in, ESG investing. Anybody familiar with ESG investing? All right. It's environmental, social, and governance investing. It's taking care of the environment, achieving social justice through investment, and then governance, taking care of everybody. And the G8 or G20 about 6 months ago said we're going to lower our carbon footprint. All the countries are going to lower their carbon footprint. Okay. What does that mean? Well, that means we're going to invest sustainably. And that's a buzzword. So if you talk to us here, we get ESG stuff all the time. And you will too if you haven't. I had a board member who's been super successful financially ask me, he said, what do you think about this ESG investing? And I said, I think greed overcomes ESG. That's just my opinion. I think when it comes to investing, making money versus taking care of the environment or making a social statement, I think greed's going to overcome it. I could be wrong, but how can you take care of the environment and other people if you're not making money to do so? So I tend to think this is a bit of a fad. I could be wrong, but it's something worth paying attention to, and you will hear about it, okay? So those are the things I want you to pay attention to and watch for as you're looking at talking to friends, looking at your statements, looking at the web, and those sorts of things. So equities and stocks. What is the S&P 500? The S&P 500 is the Standard & Poor's 500. It's the 500 largest stocks in the United States. It's a little bit better barometer than the Dow Jones Industrial Average, which we all hear about. That's a great average, but it's only 30 stocks. So I use this to kind of set the tone. So the S&P 500 at March 2009, when we were at the bottom of the 08-09 recession, was at 676. Today, it's at 4,500. We're almost 7 times higher than we were just 13 years ago. And look at the returns of the S&P 500 over the last 3 years. In 19, the S&P 500 returned 31%, 20 it returned 18, and last year it returned 31%. The historical average of the S&P 500 since its codification in 57 is 11%. That's a mouthful, isn't it? Something's got to give. So all of these awesome returns that have been historically above averages have got to come to a screeching halt. Is this the year that they do? We don't know. But we have to prepare that perhaps they do. Okay? So I also want to touch on value versus growth stocks. This is getting a lot of press, and not get too technical, but an example of a value stock is AT&T. Typically, they just sort of sit there, or they might be a little undervalued. They're going to pay a dividend. They're not sexy. They don't get a lot of press. Okay. A growth stock is Tesla. Growth stocks typically do not pay a dividend. They are screeching up in price. They're doing really well, and you're betting by buying them that in 1, 3, 5, or 10 years, their price is going to be much higher than it is today. As compared to AT&T, the price may not move a lot. It may, but it's going to have a dividend, and it's just going to sort of lay there, okay? So growth stocks have dominated over the last 10 years. Value has been completely out of vogue. And if you said, you ought to invest in value, people would say, you're out of your mind. We want to invest in Apple and Tesla and Alphabet and Amazon and Meta, Facebook formerly. Those have what has driven the S&P 500 and a lot of growth over the last. And the other point about growth versus value, at some point, last year's winners are this year's losers. Because if growth continues to perform like it has, it's just going to get so far away from its value, particularly in comparison to value stocks, that it's not going to be worth the risk, because there is risk in growth stocks. The risk is they don't deliver on those returns you're expecting in 1, 3, 5, or 10 years. Okay. So bonds and fixed income, I want to talk briefly about this. And 1.8, y'all have all heard this before, but it bears repeating. Right now, a $1,000 10-year U.S. Treasury bond is going to pay you $18 a year for the next 10 years. That's up from $5 a year just 18 months ago. So, I said pay attention to interest rates. This is one you got to pay attention to, and it tells the story. Because 1.8% is still historically low. If you look at mortgage rates, none of y'all are buying houses anymore, but mortgage rates are still really great. I remember my parents had a mortgage of 4.25%, and I thought, gosh, if I could only ever get that. Now you can get money for 3.5%. It's crazy. The other thing I want to talk about is the Federal Reserve does not directly affect this rate. Bond traders do. And what I mean directly is the Federal Reserve does not say, we're going to pay 1.8% on the 10-year U.S. Treasury. They can do things to affect it, but they don't directly say that. The bond traders do. So there are people out there trading bonds just like people trade stocks, okay? And when they trade those, they look at what the yield is on the bond, and they say, this is the yield I'll accept. Well, right now, bond traders whose only job is to make money are saying, I'll accept a 1.8% return for the next 10 years. So you scratch your head and you go, well, we got inflation and interest rates are going to be higher than they are today. Why would they do that? I don't think the bond traders believe in inflation as much as everybody else does. I don't know, but that's a bit of a signal. So a couple other things about bonds and fixed income. If you're reading, you see that growth stocks, those stocks, the Amazons, the Netflix, the Metas, formerly Facebook, the Alphabets, have really had a hard time over the last 30 days. And the reason they've had a hard time is, remember, you buy those stocks for appreciation. You don't buy them for the income, right? Well, now interest rates are starting to creep up. So investors look at those investments and they go, I can go get 1.8, maybe next year I can get 2.5 or 3% on a bond. Now I don't have to wait 1, 3, 5, and 10 years and accept that risk of those growth stocks going up. So a bird in the hand. That is why growth stocks are suffering, because interest rates are moving up. A bird in the hand, that interest you can get today is better than hoping and thinking that Tesla is going to double or quadruple over the next 5 or 10 years. And stocks in general have been hurt for the same reasons. When the 10-year Treasury was yielding 0.5% or $5 a year for 10 years on a $1,000 investment. Are you going to accept that? No. You're going to go buy a stock that's yielding 3% on the dividend or something like that, because you're not going to lock up your money for 10 years to accept that. Well, as that tide turns and interest rates begin to move up, you're going to say, I'm going to sell some of those stocks. I'm going to go buy some of those bonds that are paying more interest. That's what's happening there. So what is Fed bond buying and selling, and how and why does it affect rates? And I want to talk about this because we hear about the Fed buying and selling bonds and increasing and decreasing the balance sheet. And I'm going to walk you through it and not get too technical. So when the Fed buys bonds, they're going out in the market and buying that 10-year U.S. Treasury just like we would, and they're putting it on their balance sheet, okay? When the Fed, who's buying lots and lots and lots of bonds, puts them on their balance sheet and in their pocket, guess what? There's less bonds out there for everybody else to buy, right? So if there's less bonds out there for everybody else to buy, the prices of the bonds are going to go up because there's fewer out there. So when a price of a $1,000 bond, let's say it goes up to $1,050, it's still going to pay the stated interest rate of whatever's on there. That rate effectively goes down because you've paid more for the bond and the interest you're going to get remains the same, so your yield is going to come down. So it's kind of counterintuitive, but that's how I said indirectly the Fed can affect interest rates. They make buys, prices go down, bond rates go up. So these move inversely, prices and yields. Conversely, when the Fed sells, which is exactly what they're telegraphing or signaling now. Remember, in the last 30, y'all don't remember because we're nerds, we pay attention to this stuff, but the Fed has said, we're going to signal interest rates moving up. Well, they'll move up interest rates that they can accommodate and use, but they'll also sell bonds at some point. When they sell bonds, there's more out there, the prices go down, and rates go up. So that's just, as you read that stuff, hopefully that'll help. Okay, what does 2022 have in store? Okay, lower stock returns. We've been saying this forever and ever and ever, but we're beginning to see some cracks in the armor. Probably lower stock returns. MacArthur does not come ashore. The bear market does not return. We're probably not going to have negative returns on the whole in 2022, but probably not going to have a 31% return on the S&P 500 either. Again, we don't know. We've been saying that for a long time, but that's probable. Volatility. We've seen it in January. It has come back. With all the uncertainty out there with the pandemic, with the possible invasion of the Ukraine, with the pandemic, just there's so many things out there, there's going to be lots of volatility. Get ready. Don't look at your account every day. Just don't do it. Let the markets do what they're going to do and get ready for volatility. Shocker, interest rates are going to rise. We've been saying that for a long time as well too. But they have to rise. They have to normalize. We've been at historically low rates for a very, very, very long time. And we think interest rates will rise. How much? Don't know. Sort of like the pumpkin spice soap in the bathroom in there. It's not fall anymore. Inflation stabilizes, but not on a year-over-year basis. And what I mean by that is, at some point, prices can't continue to go up, and we'll figure out how to get more efficient based on the labor shortages we were talking about. But when you see the headline, inflation is running its fastest pace in 40 years, you go, oh my gosh, but you're comparing it to last year. You're comparing it on a year-over-year basis, not from 10 years ago. So of course, a year ago, nobody was flying, nobody was eating in restaurants, people were buying home improvement supplies and buying Peloton bicycles, and that was about it. Now, as we come out of this pandemic, we're starting to see people buy more things. So it'll stabilize, and since inflation went up in 2021, when we compare it in 2022 on a year-over-year basis, it won't seem as bad. Y'all check in with me in a year. And the last and most important thing is bloom where you are planted. What I mean by that is, and y'all hear us talk about it as clients of ours all the time, your risk tolerance. If you're sleeping good at night and you're not worried about all this stuff, you're in the right place. If your time horizon has not changed, you don't need this money sooner or later than we've talked about, don't change. Stay where you are. When we came into difficult time periods, 08 and 09, if you were in the right place, you're still in the right place. If all of a sudden you can't sleep at night because you're nervous about this stuff, that means your risk tolerance has changed and we ought to have a conversation. If you want to go invest in Mexico for some reason and you need some of this money, that means your time horizon has changed and we ought to have a conversation. But if that has not changed, you're in the right place to come into this craziness, you'll be at the right place.